Bueno, muy buenos días a todos y todas. Les presento al profesor Daniel Dalvia. Él nos va a dictar su conferencia del día de hoy en inglés. El tema está centrado en hablar, digamos, de varios aspectos alrededor de financiación corporativa. Como ustedes tendrán presente, durante esta semana haremos referencia a contratación financiera. Entonces, pues ya como para poderlo presentar formalmente, ya vamos a empezar. Daniel Dalvia is a lecturer in Banking and Finance Law at CCLS, Queen Mary University of London, an Associate Research Fellow at the Institute of Advanced Legal Studies in London, and an Associate Researcher at the European Banking Institute in Frankfurt. Prior to joining Queen Mary University of London, he was the Rooney Warrington Scholar in Comparative Law at Birkbeck College, University of London, and he was the model convener of business law at Bayes Business School, City University of London, former CAS. He's an internationally recognized expert on special purpose acquisition companies, SPACs, corporate finance law, M&A law, and regulation of financial markets, a pioneer in SPAC studies in law, author of the first book on SPACs ever published by Routledge in 2021, and our winner of the Colin Picker Prize by the American Society of Comparative Law. So thank you, Daniel, for being us today. Welcome to our summer course. I mean, it's not exactly summer in Colombia, but you will see. And we'll be happy to learn from you today. We have a numerous group. The students are around 30, 38, 39. And most of them come from the School of Law at External University, but we also have some other practitioners. So I just give you the floor so you can start sharing your presentation, and thank you for being us today.
Thank you very much, Catherine. Thank you for this invitation, and good morning to everyone in Colombia.
I don't know, something's happened with your microphone. Maybe it's your...
I do. There is some problems. Let me try.
It doesn't seem to be working.
You can hear me better now?
No, I can't hear you.
Okay. Hear me now?
No.
No.
So sorry. That's it. Let's try again.
You can.
Yeah.
Let me try.
It was me. I'm sorry. It was me. It was my computer. Sorry.
Let's see. Let me try. So now I think it's better.
Okay.
You can still. Okay, perfect. Yeah. Yes, good morning, everyone. I think in Colombia it's 7 a.m. So here in London is 1 p.m. And essentially, yes, even here is not very cold and very hot, essentially. It depends on the day. So as Catherine was saying, let's share the slides of today. And now I think you can see my screen.
Yes.
Essentially, I would like to say you are free to interrupt me. This is not probably the classic lecture where I only speak. I think it is important also for you, for increasing your knowledge, that you stop my presentation, you ask questions, or maybe sometimes I ask you questions in order to make this exercise more interactive as possible. Generally, as Catherine said, this lecture is more about financial markets, an introduction to financial markets, why financial markets are important, and also where the first example of a public company can be traced in financial history. And then from that moment, how financial markets, especially financial exchanges in a physical form, they born and how they develop. So I think that this lecture will serve for all of you as a good introduction for the next classes that you will have and that I will go also sometimes more in detail. Of course, also here we will go in details, especially if we think about the structure of an initial public offering, and then also I will give to you some hints about special purpose acquisition companies, because they might be defined as a sort of different or alternative initial public offering. So without losing time, we can start the presentation. This is just a slide that would like to give you a taste of the current times. It's taken from the Financial Times and actually is giving you the historical overview of the United States market, capital markets, and especially of the initial public offering. The initial public offering, we will see also today, especially together, is that structure phenomenon through which a private company can become public. So it is a specific process that usually is regulated, and these regulations, they come from financial regulators, but also from the state. It depends on the jurisdiction. Sometimes it's a mix of both. But mainly the initial public offering, it is that process through which a private company goes public, goes on the market for the first time. So once a company is going to sell the shares for the first time on the market, we call it primary market, and we call the process initial public offering, IPO. So here you can see in terms of years from 1999 until 2022 and 2023, I mean, looks very similar to 2022, if not worse. Essentially, this is the total proceeds of equity issuance of US exchanges in billions. So you can see that during 1999-2000, we started to have essentially a very huge number of initial public offerings. And especially we had more, almost 200 billion in proceeds. The proceeds essentially are the money that are raised on the market. So we call them proceeds. The real boom probably has been, as you can see from this chart, in 2020-2021, where we also went beyond the parameter or limit of 200 billion US dollars. So during COVID, essentially from March 2020 until the end of 2021, we experienced a huge increase in initial public offering. Part of this, it is also the consequence of special purpose acquisition companies. So something that I will speak during the end of this presentation. And this graphic already is telling you that essentially this kind of increase in proceeds in 2021 is mainly directed by special purpose acquisition companies' initial public offerings in the US. Because by that time, 2021, the SPAC made almost 2/3 of the IPO market in the US. So this is something quite important that then decreased in time, because as you can see in 2022, we started to have probably the lowest amount of proceeds ever in initial public offerings. And this, of course, it is also due, especially due to inflation, high inflation that you experience in the market, but also since the beginning also of the war between Russia and Ukraine. So this kind of new conditions, energy crisis, food crisis, and so on, has created a sort of less appealing condition for issuer to get listed on the market and to tap public markets. Hopefully, this trend will reverse very soon between 2023 and 2024. So now that we have an idea about initial public offering, a general idea, usually it's always good in law to connect ideas that are legal concepts to history and specifically to financial history. In financial history, one main interesting point is to discover when the corporation, in terms of a public company, so a company listed on the market, born. And this kind of innovation, financial innovation, actually can be traced back in history at the time of Amsterdam in 1690s. Amsterdam, by that time, of course, was the center of financial innovation in Europe. And this is because Amsterdam at that time had a privileged position, especially in exploration. Essentially, Amsterdam and the Dutch, they were exploring different countries in Europe, but also especially in Asia. And they were interested in the commerce of spices in Asia. So the story of the company has origin, in fact, in these Dutch merchants that they would like to explore new routes, new commercial routes to trade spice in Asia. Now, one point of these commercial routes is that by that time, Asia was a new continent. So essentially, Dutch merchants, they didn't know how to reach Asia, or maybe sometimes the travel and the voyage could be very risky. So for this reason, they started to think to merge together their efforts. In fact, by that time, we had 6 fledgling East India companies, but to have different companies was not efficient, as I said. So for this reason, they started to merge and to conjoin their efforts together. And they started to form one single company that was called and named the VOC, from Dutch. Of course, the Dutch acronym is much more complex and it's very difficult to pronounce, so we can call it directly with this acronym VOC, that actually can be translated in English as the East India Company. The VOC is the rival company of the East India Company in London. Essentially, they were both companies that they wanted to expand commerce and influence of those countries in the world. Those countries meaning the UK and the Republic, the Dutch Republic. At the time, in Holland, essentially in Netherlands, the VOC was a novel structure because it was a company that was a chartered company, was established for a fixed period of time, 21 years, and it started to raise capital in different cities. So it raised capital in Amsterdam, in Rotterdam, in The Hague, in different cities in Netherlands. So each city essentially had the possibility to raise money among their citizens, but especially among merchants that they wished to join their efforts in order to go all together to exploit the commercial routes of spices in Asia. So the VOC the birth of the VOC was as a sponsor, as a government sponsor entity. It was not a private company as we have today, that essentially, I mean, there are businessmen that they have a very nice idea and they set up a company and then they finance new business projects. Here, the VOC born for a public purpose. But essentially, this is something that, I mean, was not so different from many other activities in the past, in the sense that if we think about company law in general, every kind of company has been always set up at the start of the days, for public purposes rather than private purposes. So rather than a main objective that was probably to pursue private profit as a businessman, the companies, they were serving the common good. The companies, they were serving a common purpose. In this way, the VOC was serving the common purpose to try to exploit the commercial route of Asia and to try to export and import spices from Asia to Netherlands. One important feature of the VOC, we can say there were two. One is this common purpose, and also the fact that was a government-sponsored entity. But the other is the principle of limited liability. So each merchant that was joining the effort and was becoming a shareholder, it was doing this essentially by contributing money, guilds by that time, and he was doing this with a limited liability. So in reality, he could not be liable beyond what was his contribution. So this principle of limited liability has become key since then. I mean, the VOC was born before. If you think about, for example, the UK, London, there is a very famous case of Salomon versus Salomon. That is a case that is going to establish the principle of limited liability in English companies and in English law. But that came almost 100 years later. So in reality, the VOC was a very important example and probably the first example in the world where the principle of limited liability could be implemented for the first time. Of course, the VOC also represents this idea that the company is a sort of venture. So it is a venture where there is no guarantee of profit or return. But the principle of limited liability can constitute an incentive for people to join their efforts because essentially it is less risky. And so more people that will use the company as a sort of fiction in order to pursue business activities and to seek profit. Any question until here? No? Okay. So essentially the VOC, yes, we said was a company with limited liability. Now, as any company, the VOC had to pay back dividends. So let's say that the profit of a shareholder is the dividend. The dividends has always been something that is very subjective. Essentially, I mean, the directors of a company, they can decide to distribute those dividends, or also they have a discretion not to distribute the dividends. In the case of the VOC, because we said that the VOC had also a duration in time that was quite limited in time, so only 21 years, at some point in time, there was a moment where the directors of the company should have distributed dividends. But the problem is that there was not enough cash. So they didn't have enough cash to distribute those dividends to shareholders. And so by that point in time, there was an idea. The idea was to distribute rather than paying shareholders with dividends in cash. They could accept, if they wanted to accept, spices. So they could be paid in spices. Now, what is the problem of spices? Like, I don't know, anyone can tell me probably. If I pay you in spices rather than cash. So rather than having money, I pay you in spices. What does it mean? I mean, would you accept this deal or not? Anyone wants to try?
Camilo Avila wrote on the chat,
Yes.
I have to resell them.
Yes, that
might be one of the downside of accepting the deal.
Yes, that can be one point, Camilo, exactly, in the sense that if I have all these spices, how I can resell them, or if I have all these spices, where I can store them. So it is impractical, essentially. And then it's very good the point of Camilo, because essentially how I can resell the spices, maybe not everyone needs spices. So this is quite.
And then you have to assume the risk associated with the thing, with the asset that you're receiving.
Exactly. So for this reason, I mean, this was creating a problem. And the shareholders, some of them, of course, they decided to accept this kind of payment, but others, they said they refused this kind of payment. And they had another idea. So essentially, from this kind of problem, there was a solution, and this solution was the creation of a new financial innovation. And the new financial innovation is the stock exchange. So essentially, they went in a market and they started to trade share certificates. So they initiated what today we call a secondary market. And this is the picture of the building that was the place where this trading of shares was occurring in Amsterdam. Now this building does not exist anymore in Amsterdam because essentially was teared down by authorities 200 years ago. But still, that is where deals were made. So merchants, they were meeting there for commercial purposes, not to sell shares. But the fact that is that, I mean, by chance, then they started also to sell shares once the VOC could not pay dividends. And that is the moment where, by chance, actually, the first stock exchange in the world was created. And then, as you know, this kind of evolution 150 years later started from the London Stock Exchange that was founded in 1773, the New York Stock Exchange founded in 1792, the Nasdaq founded in 1971. So the Nasdaq, as you can see, is quite recent, while the oldest stock exchanges are Amsterdam Stock Exchange, London Stock Exchange, and New York Stock Exchange in the US. Both these three, essentially, Amsterdam Stock Exchange, London Stock Exchange, and New York Stock Exchange, they all born essentially from informal historical event. So in the case of Amsterdam, this informal historical event is the trading of share certificates in a market. In the case of the London Stock Exchange, before the physical London Stock Exchange that today is close to St. Paul, we could find an informal exchange that were located in coffee houses. So coffee houses were very popular to trade shares, essentially. And especially in London, I mean, before 1773, there was the possibility to trade shares where today is the bank tube stop station. So there is where there was Exchange Alley. So essentially was one street, especially where there was this kind of trading of shares going on. And then everything moved from the street, essentially, to physical closed exchanges. And this is the same story in London, it's the same story in New York, because even by that time in New York, before the New York Stock Exchange, that was a closed physical exchange, before all the trade was occurring on the street. And also by the time of the setting up of New York Stock Exchange, there was New York Stock Exchange as a formal venue, market venue, and then there was another type of market, and this market was not official, was the non-regulated venue, and essentially the CARB market was called. And the CARB market is where also very important, I mean, corporations that started to trade. So this is something that can show you that sometimes if a company could not enter formally in a physical formal exchange, they could still trade their share in some informal markets that was more risky, but also the liquidity there was higher because essentially the speculation activities in an informal market were also more important or more diffuse in some way. And so this could boost also liquidity in the market in comparison to the formal regulated exchange. So just to recap, in general, financial innovations are not something negative. Usually financial innovations are synonym of progress in society, and they can contribute actually to the establishment of new commercial use, like in the VOC, but also to the establishment of new companies, like in the case of the London Stock Exchange and New York Stock Exchange and NASDAQ. And essentially then, of course, this is just the start of the story, because then today the most liquid markets in the world are NASDAQ and New York Stock Exchange. So even if the US is a new continent in comparison to the old continent of Europe, where everything started, the US potentially in financial markets has become a very important model. Even if we think about the securities regulation of the US, so the Security and Exchange Act 1934 and the Securities Act 1933, in reality, those Securities Act are a real model of the future. So are a model on which even the European securities regulation actually they started to be modeled on. So now I don't know in the next days what is your schedule, but basically always remember, if there is someone speaking about the US or someone speaking about Europe, actually the majority of regulations in the world are always based and modeled on the US capital markets. So this is even the reason why to study US capital markets is quite interesting and important. And then, of course, this evolution from physical exchanges also became something different with the digital exchange. Some of you wants to say something about digital exchange. Do you know something about decentralized finance, centralized finance?
I guess giving some ideas around what happened in Colombia is, I mean, we have a dematerialized capital market as well. And however, the Colombian market structure responds more to a traditional way of understanding that all the activity is actually done in a physical place. That there's something new, I mean, relatively new, which is the opportunity for us as small participants of the market to buy shares directly by using some new apps. And actually there's part of fintech startups promoting the use of this sort of market, let's say somehow, as they say here, somehow to look for a democratization of the market and to look for new resources, which might be something similar to the decentralized finance movement, but is something that we haven't seen in a greater part of the market until now.
So essentially, it's like it's always the exchange that has this app. So
yeah, exactly. Yeah, we have one that is actually managed by it would be Colombian Stock Exchange, but there are some other intermediaries that are promoting the use of this sort of apps.
And in fact, that is very interesting, because there is this big debate between centralized finance and decentralized finance. So what I have shown you until the slide before, we can call it traditional finance. So traditional finance actually is a finance that is based on real assets. It's a finance where probably there is no space for digital. At least at the start, there was no digital or digitalization inside the traditional finance. But then traditional finance started to become also digitalized. So sometimes, for example, in traditional finance, we speak about the tokenization of assets. So some financial assets or new financial assets can be created via smart contracts. And these smart contracts, they can operate on the blockchain. So just to give you an example, for example, there are already investment banks that are thinking to use blockchain blockchain as a private instrument within their network in order to transfer, for example, assets from one position to another in a way that is quicker. So in the same way, for example, there was in the UK in October 2022, a big problem with pension funds. There was a mini budget reform, and then there was a crash in the pension fund industry. At that time, there was a problem from pension funds to cover the margin calls on the gilt bonds, gilt market in London. For example, if the assets of pension funds they were tokenized, this kind of covering margin calls would have been simpler and quicker and more efficient. So traditional finance is studying a way to take advantage of the financial innovations that is today is about digitalization in the market. So there is a sort of union between traditional finance and decentralized finance, for example. But it's also true that the big problem was that since FTX was a crypto exchange. So what is crypto finance, and especially what is centralized finance? So centralized finance is a way where there is an exchange like FTX. They want to take, of course, and at the time they took custody of funds. So they were acting as a custodian, but then because there were problems, especially from a corporate governance perspective, inside the structure of the corporate structure of FTX. For this reason, then, I mean, there was a fraud that was quite big. And so for this problem, from this kind of ideas that we encountered that they were, I mean, quite problematic, they started to think to regulate essentially centralized finance. But centralized finance is something that would like to act in some way as traditional finance. So for example, in Colombia, I think in this way is good that there is the Colombian exchange, like the stock exchange that is already under certain securities regulation that can act in as a custodian. So basically, the problems that you find in FTX, you cannot find now with this app that is connected to the Colombia Stock Exchange. So this is something that since the collapse of FTX has changed many things, because centralized finance is not seen anymore as the future, probably. And also this kind of distinction is the distinction that probably many people that they work or they operate in cryptocurrencies, they know, but many people that they work in traditional finance, they don't know. And actually, they don't even have to know, because essentially this kind of distinction is still something that does not make much sense. Essentially, if you want to act as an exchange, you should be subject to the same rules that are destined to regulate a traditional physical exchange. Mm-hmm. So this is something that is still, I mean, in progress as a discourse.
Do you think that this regulation that is being discussed in the House of Lords now, I guess, around understanding crypto assets as a regulated activity? Maybe
yes.
more or something like that. It would be end up on somehow formalizing the crypto asset market and this way of digital exchanges. Because for example, here in Colombia, we have is a large market, more or less, large market on cryptocurrencies. Mm-hmm. Actually, within the region, Colombia is one of the countries where you can find the big part of Bitcoin and so forth. So it is not that it's not happening. Is that we don't have rules around that. And actually, in our Congress would be the Parliament here. They've been discussing different projects to regulate exchanges. as a way to access the information what is going on within the crypto environment. But until now we don't have a law that is actually enforceable. So do you think that it tends to change in the UK now that they are
I think, I mean,
forced
yes,
to consider as a regulated activity?
yes, they would like to regulate, I mean, cryptocurrencies, but especially they have a big focus on stable coins. So in reality, they would like to say that stable coins that can serve purposes of retail investors. And so, for example, to promote even inclusion and access to finance, they would like to regulate stable coins so that if there is a retail investor that wants to pay the shop with stable coins, in this way they have a secure framework where consumers, they cannot be defrauded. So this is one kind of financial innovation that the UK is working on. Although I don't know really in Europe, in the UK, how many people they will use stable coins, because Europe in general is an old continent in any case, I mean, in the sense that even people are very old. So I don't imagine that many people that are old, they know how to use stable coins or they have digital wallets. While in South America, for example, developing countries, not everyone has a bank account, traditional bank account. So possibly there is a big market also, can present many opportunities also for investors to invest and to offer stable coins, for example, there. There is, of course, the concern that in stable coins, for sure, stable coins are not good for traditional finance and qualified investors. Because if we see, for example, Silicon Valley Bank had one depositor that was one of the biggest stablecoin providers that deposited 3 billion of stable coins in Silicon Valley Bank. And when essentially they wanted the money back, 3 billion is a lot of money to give back. And so in reality, this is already something that can signify that traditional finance does not want anymore something related to stable coins and something related to crypto finance, because actually it's very risky and can even cause a collapse of a traditional bank. While retail investors, yes, they might want this. And so more than one lawmaker. So even, for example, in this moment, even last week, there was, I mean, the US Congress, they are thinking about adopting specific rules for stable coins. But generally, even there, from a consumer protection perspective, so we need to protect consumers. And this is basically the future, that stable coins are becoming always more a product for retail investors. So this is where US, UK, they are similar. They want to regulate stable coins from a consumer protection point of view. They are still not making a lot of progress on regulating, for example, crypto finance and extending maybe rules that are related to traditional finance to crypto finance. Still, this is something that some they would like to have, others they oppose this idea, because if we extend traditional finance rules to crypto finance, we can have a sort of disaster, in the sense that the systemic risk can even be increased because there is more connection between crypto finance and traditional finance. So this is something that still today is in evolution. We don't have a certain answer yet. But for sure, this is, I mean, something that even your students, they might be very interested to read. So essentially, if you read newspapers like Financial Times, Bloomberg, but also Wall Street Journal, you will find out that this is always on newspapers, this kind of debate about decentralized finance or decentralized finance, and how is the future of finance, even in terms of digitalization, but also in terms of artificial intelligence that now is coming into finance. So for example, while in the past you could directly, I mean, have some experts to direct you in investments, especially from mutual fund, there were specific teams of real people. Today, maybe artificial intelligence can provide people with an investment decision or strategy, but this is something that still it is in an unknown field. We still don't know how this can be made, what are the consequences of wrong advice, and maybe there are people relying on artificial intelligence and they are investing money and then they are losing money. So this is why in reality this digitalization in finance is creating new problems. At least some of them, they might be new because even the entities are new, like artificial intelligence. But at the end of the day are always solve problems in the sense that you might find a new financial crisis, you might find a systemic risk, you might find speculation. So in reality, the problems in finance will always be the same, but maybe the form and the shape that we can see these problems happening then can always differ and be different in time. So this is what I think will be in the future. So now after this introduction that I think is quite complete, I mean, in the sense that you can have a better idea how finance is working. Let's start with the question to you, why we go public, why a private company would like to go public? And so to tap the public market, the stock exchange, the one that we saw before in the slides. Any question? Sorry, not questions. Any idea on why a public company would like to tap public markets?
Camilo.
Maybe to win investment and to raise the price on the stock market?
Yes, to raise the price of the stock market in the sense that to have their shares valued in public markets. And so what does it mean? This is good. I mean, you are going towards the idea. So for example, if I have shares that are traded on a public market, on the stock exchange, what is going to happen to me as a sponsor, as an issuer? Or what is going to happen to the shares that they are traded on public markets? Any idea?
I guess just to help here a bit, you might have access to better investors, very quality investors. Probably, I guess you can also find more flexibility comparing to the banking products and services. You make yourself well known in the market, so it's something about reputation as well. I don't know, more visibility, probably, but greater confidence or trust on what you're doing.
Yes.
Because I mean, the fact that everyone in the market is going to have more information about what you do, I guess is somehow linked to greater level of trust.
Exactly. This is quite interesting, the fact of trust. So trust is always there because we need always to think that if we are in financial markets, we are in a place where we have two different actors that are going to interact with each other. On the one side, we can have the lender, and on the other side, we have the borrower. So this kind of relationship is everywhere in financial markets. And if you are a businessman that is running a private company and then you want to become public, you are actually on the side of the borrower. So the borrower in financial markets is always the one that wants to take risk. And then the lender is the one that want to be risk averse in some way. Why we should be public? In reality, in the development stages of a private corporation, we always have this desire to go public. So if you run a startup, usually you need to develop your company. To develop your company, you write a business plan. If you write a business plan, then you need money. But if you need money, there are many ways to get this money. So, or maybe your father, your mother can give you money. And that is called angel investor, for example. Then if this is not possible and so it's not within your strict family, you can maybe ask this money to more formalized people, and so are venture capitalists. Venture capitalists, they will run specific round of financing. So they are giving you money to invest. They invest money on you. Essentially, they bet on your future profitability. If you are lucky enough or you are good enough to pass some round of financing in venture capitalists, you can then try to achieve or to tap public markets. So to tap public markets is a process that takes long time. It is a process where also, in reality, they will look at your finances, they will look at your balance sheets. So you need to have constant and consistent financial results to be able to get public. So one point for sure is that initial public offering is not for everyone. It's just for people that essentially they have money, they have consistent results. For example, Facebook, yes, could tap public markets because it was a big company. But there are many other companies in fintech that they don't have the same ability and possibility. So to go immediately in an initial public offering, that today we can call it a traditional IPO, it is quite difficult and costly for companies. But still, they want to go public because it's the last stage of development of any company. And once you are on the market, you can access a larger investment base. So for example, you can maybe reach investors all over the world. Your goods or products, services that you offer, they might have more visibility staying on the market. So there are all positive ideas behind this. And in fact, I mean, in this next slide, you can see I just summarized for you the different ideas that we discussed until now. Let me see if I can, yeah. Yes, I don't know why, okay, perfect. So this is just for you once you review the slides. And also, if you have any question then after the presentation, and especially during even next weeks, you always have my contact details, so feel free also to contact me by email. As you see, the main advantage is the thing that we said before, and this is probably the most important, the access to capital to fund growth and to reduce also consequently the debt in the corporation. So I said before that we had the traditional IPOs. Traditional IPOs is the normal way. So reality is the way that has always been. It's the way of the VOC. So where we raise money from different investors and we offer shares for the first time. This is a traditional IPO, and that is a primary market when I offer the shares for the first time. Then in the US, they started to think about the possibility to have other alternative ways of initial public offerings. So the other way could be a direct listing. The big difference between a direct listing and traditional IPOs is that in traditional IPOs, there is always an underwriter. So the underwriter is the investment bank. The issuer of new shares must work in conjunction with the investment bank that is the gatekeeper of the market. So the underwriter is key in traditional IPOs because the underwriter is the actor that is going to examine the balance sheet of the issuer, is going to write with lawyers the prospectus. Essentially, the prospectus is like an agreement between the issuer and the new investors of the company. So in the prospectus is written who is the issuer. In the prospectus is written what are the risk factors of this company. that is offering for the first time new shares on the market is written a story essentially in the prospectus. It's written also the story of development of the company. The thing that I told you, if you are a startup today and then you are lucky or you are good, especially to obtain new financing from private actors like venture capitalists, angel investors, and so on, you can little by little develop your network, develop your products, your services, and you can increase your profit. And then at some point you can be mature to tap public markets through a traditional IPO. One main point is here is the underwriter, as I told you, but the underwriter needs money. So, I mean, there are fees that you need to pay to the underwriter. If you need to pay an underwriter, sometimes can be very expensive. And this is something that, I mean, makes the traditional IPOs not very competitive as a process. So sometimes, if you already know people that you want, that they want your shares and they are ready to buy new shares from your company, you can directly avoid the possibility of having an underwriter, and without an underwriter, so you reduce cost, you reduce also time, and you can tap public markets through a direct listing. So it's a way where directly the issuer is going to directly list itself through a network of friends, we can call it, through a network of people, qualified investors that are going to sustain the issuance of new shares, and they are going to buy the issuance of new shares. Why? Essentially because they know you. Otherwise, you need an underwriter because not everyone knows you as a company. So sometimes you can tap public markets in a traditional IPO, and rather than selling 100% of shares, you are short of 20%. That 20% can still be bought by the underwriter. So the underwriter is also explaining a role that is a mitigation of risk. So reality is mitigating the risk that you are not selling the shares on the market. So for this reason also, many companies, they prefer to go public via a traditional IPOs because there is an underwriter that is protecting you. Sometimes this buying of new shares that are outstanding and are not sold to market participants, sometimes it is compulsory. So the investment bank must buy those outstanding shares. Other times, it depends how the engagement letter is written between the underwriter and the issuer. Other times, the investment bank will act on its best effort. So in reality, cannot assure or is not obliged to buy the 20%, for example, outstanding shares, but will try to buy a percentage of those shares and to list those shares, the remaining shares, to any other investor that can be found within the network of the investment bank and within the network of markets. So in reality, it depends also how you structure this engagement letter with the investment bank. Of course, if there is an obligation from the investment bank to buy the outstanding shares and so then to complete the initial public offering, this kind of contract is more expensive. So in reality, you need to pay higher fees upfront to the underwriter. So you start to understand that essentially this process is a costly process and not every company can afford to go public. So for this reason, another way that has emerged, in particular between 2020 and 2023, is the special purpose acquisition company. So the special purpose acquisition company, we will see a little bit, is a possible new alternative way to go public, because in this case there is a cash shell company, so a company that is not operating company. It's not a company that is selling a pen, for example, or producing biscuits. It's a company that does not offer any service and does not produce any product. It's a company that is called a cash shell company. So in reality, it's just an empty shell. It's a company that is set up today and it is listed tomorrow on the market. So the main purpose of the SPAC is just to collect all the proceeds from public investors in an initial public offering, and then subsequently to find a suitable target to acquire. So it means that the private company, that is the target company, via a SPAC can be listed on public markets without going through the traditional route of traditional IPOs. So in reality, the target company is eliminating some cost on its side. Is clear to you this? Any question on this?
Yep.
Okay, very good. So this also for you, the initial public offering, IPO. This is something that can always remind you that the main actor, the issuer, is at the center of the slide, and is the company. Then you have different other actors of players in this initial public offering process. You have the book runner, you have the lawyers, the reporting accountant, the financial PR, other advisors. So there are many players that needs to be paid in fees. And some players, they will also stay after the listing. So for example, because there are continuous obligations that listed company, they need to fulfill with the financial regulator, lawyers are always needed, for example, and also underwriters sometimes are always needed. So for this reason, the IPO is a costly process, not only because you need to face the different costs at the initial stage, that is the IPO, but also post-IPO, there are continuous obligations that you need to essentially fulfill, and then indirectly you need to pay. For example, if you want to list on the London Stock Exchange or New York Stock Exchange or any other exchange in the world, you need to pay a fee also to the stock exchange. And this fee at the start is like a club members. So in reality, it's like a club. You need to pay a fee, and the initial fee is always higher. Then once you stay in the club and you are a member, the fee is lower, but still every year you need to pay this fee. So this is something that has a cost, and this is something that also reminds you that any company that goes public must have also, or must at least reserve a part of the capital of the company, of the cash liquidity, in order to pay for all these expenses, essentially. Lawyers, of course, they must be involved in the process as soon as possible. So lawyers are the one that they write, for example, the prospectus. Lawyers are the one that are going also to issue legal opinions when it's needed, also in the pre-IPO phase. The book runner essentially is the one directing this process of listing the shares on the market, and sometimes for big initial public offering, we have also more than one underwriter. So there are some underwriters that they share roles. Some of them, they are going to place the shares on the market. Others, they are going to work maybe with the issuer in order to write a memorandum of the offer that will serve also as a presentation to investors. So there are many activities. The process is quite long. Already to arrive to an IPO sometimes can even take 1 year. If you think about 2021, there was a case of Ant Corporation in China, of Jack Ma, that failed. That IPO failed after over 1 year of negotiations with the financial regulator. So in reality, to go through the process of a traditional IPO is quite risky. The main actor in this process, I can say again so that you remember for your knowledge, it is the underwriter, the investment bank like JP Morgan, Goldman Sachs. Those underwriters are key in the process of the IPO because since the enactment in the US of the Securities Act 1933, we can see there in that act especially that the underwriter is the gatekeeper of the market. This function of being the gatekeeper of the market, it is in the US and then started to be spread around the world. So the same model is in Europe, the same model probably is in Colombia, everywhere. The underwriter is key to tap public markets because it's going essentially to facilitate the role of the financial regulator and is going to carry out a thorough due diligence of the issuer. During COVID, and in fact, if you see in this slide at the start, you see also the increase of traditional IPOs or in general initial public offerings. They were on the rise. And why? This also because if you are the gatekeeper, you are the underwriter, in the past at least, you needed to go physically to verify the condition of the issuer. So if the issuer was, I don't know, a company in Malaysia and claimed that they had 36 offices around the world, the underwriter that maybe was in the US, so the company in Malaysia wanted to list on the New York Stock Exchange. At that point, the underwriter in the US, like Jefferies, for example, they started to travel around the 35 offices around the world of this potential issuer in order to verify that actually the 36 offices were in existence, the 36 offices, they had certain characteristics and they were not fake offices, for example. So those were things that were done, especially in order to verify the reliability of the issuer, in order to increase trust in the investment and to investors. So again, trust is key in financial markets. Now, during COVID, March 2020, this thing could not be possible because there were restrictions in the world to travel, to access new countries, so there were a traveling ban. So for this reason, everything, also the roadshows, so the presentation of the company to new investors or potential new investors happened and occurred on Zoom. So in reality, for this reason also was simpler and quicker to tap public markets during COVID. Because essentially even the controls and the checks on corporations was lower potentially. So this is always something that we need to take into account, the external financial conditions or potential events that can occur on the markets that can be reflected also. Here is an example, I mean, of a market. This market that I took as an example is the London Stock Exchange because I live in London. But this can be done also for the US or for any other kind of countries. Usually, as any country, you have more than one market segment. What is a market segment? Is a segment of the market that is dedicated to specific issuers. So for example, the main market on the London Stock Exchange has different segments, the premium segment, the standard segment, the high growth segment. So in reality, it depends where you want to be listed. Each segment has different rules. So for example, if you go on the premium, you must have, as an issuer, at least 3 years of certified balance sheet. Otherwise, you cannot be listed on the premium. If you are on the premium segment, for example, you must comply with the corporate governance code in London, something that you don't have to do if you are on the standard segment. So the main market is the London Stock Exchange flagship market, so it's the most important market in London. Then in London, we have also other markets, one always under the London Stock Exchange group, that is the alternative investment market, AIM market. and that is for smaller and for growing companies. So the difference between the main market and the alternative investment market is that on the AIM market, everything is a little bit simplified. So in reality, even the level of disclosures, of the level of precision of the prospectus has to be lower. So rather than call it prospectus, that is more a formal document, on the AIM market is called a document offer, an offer document. An offer document that is similar, of course, to the prospectus in the sense that you find out who is the issuer, you find out what are the risk factors. So in reality is very similar, but of course, maybe there you don't have to disclose many financial information as much as the main market and the standard segment or premium segment. So in reality, the choice of the market is one of the first things that an issuer has to think, and also the purpose, why we want to get listed. Why this? Because as I told you, if you are an underwriter, you are checking the information of the issuer has to tell a story to investors. The investors will buy shares because they trust the underwriter and because they trust the issuer, because they have interest to buy new shares. Otherwise, I mean, this process cannot even be sustained. Any question?
Just to clarify, those other markets, I mean, all the others that are not the flagship one,
Yes.
all of them are managed by the London Stock Exchange Group? Okay.
Yes, by the London Stock Exchange always, apart from one market that is not even in the slides, I think, because it's very, very small, that is called the Aquis market. The Aquis market in London.
Okay, and the difference is that these other markets are more flexible and they are not obliged to comply with corporate governance rules. I mean, not the highest standard. It's not that they don't have corporate governance, it's that they don't have to follow the highest standard of corporate governance.
Yes, exactly, like the AIM market, the standard high growth segment.
I bring this to your presentation, Daniel, because we had an experience within COVID for an exceptional regulation that it was enforced over 2 years. And the idea was to give an opportunity for the small and medium enterprises in Colombia to access the stock exchange market. But the idea there was that they could only issue bonds and debt products, not to sell shares. And one of the exceptions was actually the corporate governance part. And because of course small and medium enterprises are not so familiar with the idea of corporate code, governance code and codes of conduct and so on. Until now, we've seen a new plan of the new government to open that market here, but we will see how it works. So my query was whether those other markets are also managed by the London Stock Exchange Group.
Yes, like the main market, AIM market, all these markets here are all managed by the London Stock Exchange Group. The AIM market also in the past, for example, the London Stock Exchange Group in the past had also Milan Exchange. The exchange in Milan was under the London Stock Exchange. But then after Brexit, that exchange in Milan was sold to Euronext. Euronext is the main pan-European market in Europe. So in reality, we have Euronext Amsterdam, Paris, Lisbon, Milan. So in reality, it's a big pan-European market, and now Milan is the last addition to this European Stock Exchange. So Milan before was under the London Stock Exchange Group, and now no more. And so even in Milan, we had the alternative investment market, and now they define it in another way because it's under the Euronext label. So, but in general, both this AIM and main market are under London Stock Exchange directorship and supervision. Then we have another market in UK, in London, that is the Aquis market, and that is completely under the directorship of Aquis. That is a small, very small capital market, because the capitalization of a company is 2-3 million, for example. So it's for very small, medium size, but more small companies. So that is something that is not under London Stock Exchange. So London Stock Exchange, in the case of Aquis market in London, does not have nothing to do with it. So that is the only exception. And here you can see the things that I told you, like if you are on the premium listing, that is the same segment of the main market under the London Stock Exchange, you are required to meet super equivalent standards. In the standard listing, you meet minimum standards, so less prestigious. I mean, for example, blue chip companies, they are all on the premium listing rather than the standard listing. It depends where you want to be listed. Essentially, I mean, for example, different special purpose acquisition companies in London. One venue that is very popular as a market is the standard listing. And then after, or even the alternative investment market, so the AIM market for SPACs. And then after a while, when the SPAC has completed the business combination and so on, they tend to transfer and list again on the premium listing, because the premium listing is more prestigious. So in reality, because, for example, we said the SPAC is a cash shell company, so does not have balance sheet. So it means that cannot list directly on the premium listing, because on the premium listing where you list that you must have at least 3 years of balance sheet. So the SPAC cannot by definition list on the premium listing. But this same requirement is not requested on the standard listing. So this kind of different rules also can give flexibility to the market, and can give flexibility also to the issuer and participants to select which segment is best to apply. And of course, another point is also that in initial public offering, you must be accepted as a client by the underwriter. So the underwriter is the gatekeeper, but also the underwriter has to accept you as a client. If this is not happening, this can be quite problematic, because the underwriter is the only one that can list your shares on the market. And so also sometimes it's important that you are introduced to the underwriter. Usually underwriters, they tend to work with clients, with people that they already know. So in reality, sometimes it's very difficult to become even a client of JP Morgan, for example. So these are also other challenges that they might be faced, or especially if you are a foreign issuer in another country. So if you are from Malaysia, you want to list in Italy, in Milan, maybe investment banks there, they might oppose the idea that you are a foreign issuer and you want to issue new shares in Italy on Italian markets, or the same in London. So those are things that, I mean, they are all specific, and they can all change depending on the country that we are taking into account. And then the high growth market is another market segment that I was telling you before, that forms part of the London Stock Exchange main market. Now, if you are on the main market, of course, as I told you already, you need the prospectus. And there, essentially, it is a sort of more important formal offer to public investors. In fact, with the prospectus, you offer your shares to the public, and you apply also for a mission of trading to a regulated market. So markets that they have specific rules, the standard segment, the premium segment. But then to the prospectus idea, there are some exceptions. So for example, if rather than offering those products, those, new shares to public investors that are even qualified investors, but they are investors that I don't know. Sometimes it's possible that I offer this to people that I know as an issuer. So in reality, that is a private placement. So in a private placement, for example, you don't really need a prospectus, or maybe if you're offering new shares only to qualified investors, so there are no retail investors in the process. In this case, it's also you don't need maybe a prospectus, or you need an offer document or something that is really an offer circular, something that is a sort of memorandum to recap the terms of the offer, because all those investors actually they have a very high knowledge of risk. And so this is another point that is important also to determine from an underwriter perspective the extent of the due diligence process that an underwriter has to conduct on an issuer. And sometimes, in Europe also, fewer than 150 persons in each European member state. In reality, this is something that is also an exception to the prospectus rules. So this is something that more relates to financial regulation, but is a principle in reality that is observed worldwide. So as a general principle, if you offer the shares to someone you don't know, you have to inform and disclose information to that someone even more in comparison to someone that you already know. So that is also logical, and this is something that also as a key reminder, and to sum up, essentially, disclosures are key in financial markets, and especially on the side of issuers. So this is another slide that is going to recap this, and it's something, you can also read alone later on. Important probably is here even the type of documents we already said, but this is a good recap that the aim, you have an offer document, admission document on the main market, the premium and the standard segments. You have a prospectus. Sometimes you don't need, for example, this is something that is interesting on the AIM market. There is not a minimum free float. So the Nomad actually is the investment bank, is the nominated advisor, is called Nomad. And it is the investment bank actually that even there has to understand the suitability of the issuer. So the underwriter, as always, as I told you, is the gatekeeper of public markets. Without the underwriters or without brokers, you cannot sell your shares on the market. So you cannot do alone unless you go in a direct listing. So in the direct listing, you don't need an underwriter. Of course, because, and this may be a point that is quite interesting, the alternative investment market is less regulated. Because it's less regulated, the nominated advisor is something that is required and is very important to have, because the nominated advisor is taking also a huge responsibility in that market to assure that an issuer is suitable to stay on that market and to offer shares on that market without the possibility, of course, that investors might be defrauded. So in reality, the nominated advisor is playing also a higher role in those markets like the AIM that are less regulated. While in the other markets that are more regulated, this higher level of regulations can always implement or reflect the fact that because there is law inside the process, the role of the underwriter is important, yes, but it's always something that, it has a sort of help from the law. So in reality, issuers, they will be more scared to do something wrong. It's not only the underwriter that has all the responsibility to list companies on the market. And so the main question is how we can understand whether a company is a good company or not. And this is something that relates to the lemon problem. I don't know if you know, if you ever heard about lemon problem.
I guess it is better if you give context to the
Yeah.
lemon.
So essentially, it's very simple. Like the lemon problem has been especially, let's say, not invented, but I mean proposed for the first time by Akerlof. Akerlof actually wrote this lemon market problem paper. In this paper, for the first time, in reality, is starting to pose questions and problems related to lemons. So like the lemon market, if there is a lemon and they are all yellow and they all look the same, how a consumer can understand that there is a good lemon and distinguish the good lemon from the bad lemon? And in reality, there are different things that actually can be done from a market perspective. So this is called like signals. For example, this kind of signals in financial markets, we can find them in disclosures. So if a company is disclosing information, the more information are disclosed, the better it is. Because essentially, if we have informations that are disclosed, then the investors that are public investors, they can evaluate better the level and reliability of the company, and they can trust the company. Although the level of disclosure is not guaranteeing the profitability of the company, so still maybe we can buy a share that is valued at good price, and then maybe this value can be destroyed in a few months. This is something because in financial markets, there are also events that are beyond the control of the parties. Some events that are beyond the control of the parties can be inflation, can be a riot, a war, so an act of God, for example. These are all things that are not under the control of the market, but still can influence what the market is about. In the case of things that we can control, actually there are things that we can control, because these are things that we can state in the prospectus in the risk factors. So the risk factors is where I disclose as an underwriter all these different features that are important to be known by public investors. Some public investors, of course, are qualified investors like hedge funds, pension funds, mutual funds. In reality, those are investors that they have analysts. So in reality, they can know very well financial informations. While in the case of less informed people like retail investors, there is more difficult. They need to be more sophisticated. So for this reason, the level of disclosure is key for them, because can play also a role in consumer protection. Any question on this?
Currently, just to provide some ideas about the Colombian market, we have a great problem with how this prospect of information that we call here is being regulated. Because as you say, it's exactly the same problem that it seems to be that if you standardize the sort of information that is provided to investors and the market, you have greater chance to be successful in an IPO. However, recent cases of IPO in Colombia have shown that that's not the case. Actually, the level of standardization is not working for that purpose, and we end up with many investors fleeing the market, and with capital market that is with high liquidity problems. So as you mentioned, it seems that these problems of capital markets never end up being completely resolved. And it is one of the areas that we are expected to see somehow reform in the Colombian context.
Yes, exactly. I mean, like this is something that is universal. It's not only done in Colombia. It's something that disclosure or the level of disclosures will always be discussed, because even in special purpose acquisition companies, this is a big point where essentially the actors, they are always claiming what is disclosure, what type of information that should be disclosed, what else, for example, the SPAC sponsor should do in order to inform SPAC investors about the future composition of the company after the business combination. But this is something that, for example, at the moment of the IPO, is difficult to project what a SPAC will look like post-business combination. But still, regulators, they would like to have an idea, because they think that, of course, then public investors, they can be damaged in terms of profit or profitability at the business combination moment. So disclosures will always be a big argument of debate. But the main idea behind disclosure is from the US securities laws, where essentially, because the idea is that the financial regulator cannot oversee everything everywhere, in some way the disclosure is a way through which the market also, with the market participants, between the issuer, the public investors, they can in reality start to trust each other. They can disclose information, and this type of disclosure can serve a purpose of trusting each other in some way, without having the regulator every time to impose new disclosure, or without having the regulator every time to oversee everything possible. Of course, in a prospectus, this is something important always to remember. The prospectus must be approved by the financial regulator. So in reality, I mean, if the financial regulator might think that the disclosures are not adequate, they can ask an integration of those disclosures. So in reality, for the regulated markets, like, I don't know, the premium segment, the standard segment, there is always a supervision. While in the case of the offer document, we don't need this supervision of the financial regulator. There is just a letter of comfort letter, that is written by the underwriter on the alternative investment market, saying to the financial regulator that everything looks fine. So in reality, for this is an offer document, it is simplified. While in the case of a real prospectus, that is not simplified. So that is the point. There is always the supervision of the financial regulator at some point. And this is something that is more for you, for your knowledge, and especially for to keep a record. Essentially, you can come back to the slides also, maybe in your professional life, to see how a traditional IPO usually is developed. So there is that equity story that usually takes 3 months prior to pricing to be written. So it's something that takes time, as I told you. If you see 4, 6 months, 3 months, 2 months, 5 weeks, so in reality, the months are passing, and this is something that can show you traditional IPO is not something short. It's something in the long run. The main point is the roadshows, something that maybe we didn't speak. We spoke about many things, but not roadshows. But roadshows is very simple. Basically, we need to offer those shares to investors. To offer those shares to investors and to have already pre-booking before actually being on the market, you are running roadshows. They are called roadshows because in the past, actually, physically, the issuer was going on the road, visiting different cities in order to sell the company to those investors. Now, these roadshows are no more on the road, because many times, as I told you, at least since COVID-19, yes, was a new phenomenon where today the roadshows, they can be run on Zoom calls. So it is simpler, easier, quicker. This is something that in reality the investment banker will prepare and assist the issuer. For example, if the issuer does not speak English, or the issuer does not speak German, if we want to list, I don't know, in Germany, the The underwriter usually also provides some interpreter. So the underwriter is always present in these roadshows because he's going to assist the issuer to sell at the best possible way the shares to potential investors, that usually these investors are the clients of the investment bank. So in reality are people that already knows the investment bank. They can even be accredited investors. Who is an accredited investor is a person, an individual, physical individual, that usually has a net asset value of asset under management of at least 5 million. That is an accredited investor, and it can be, or she can be invited to those roadshows, for example, if they want to invest, for example, in equity, or they want to invest in the issuance of a new bond. Because even for that, I mean, in reality, even a bond, I mean, can be issued for the first time on the market. So bonds are an example of debt as opposed to equity, that is shares, essentially. Primary market, I mean, we said, is when I sell for the first time the shares on the market. As you can see, the company and the shareholders, future shareholders. Secondary market, the investors sells to investor. So in reality, the secondary market, just from a financial history point of view, is the VOC. In the VOC, actually, the first Amsterdam Stock Exchange born from the fact that the VOC did not have money to pay in cash dividends. They wanted to pay in spices, and so some shareholders, they started to trade and to sell investor to investor share certificates. That was the secondary market, and that is something that is happening on the stock exchange. And so for this reason, actually the first stock exchange in the world born out of that phenomenon in Amsterdam, in the VOC. So that is the secondary market. And as I told you before, I mean, this is not something new. If you are on the market post IPO, you need, of course, to fulfill continuous obligations that are imposed by specific rules. These rules can change in every legal system in the world. Every jurisdiction has different rules. Plus, in addition, there are also specific rules that usually are enacted by the financial regulator. So the Security and Exchange Commission in the US, the Financial Conduct Authority in London, and so on. I mean, every country has one. And essentially, those are the regulators that are in charge of supervising financial markets. To supervise the financial markets, it means also to enact specific rules for companies that are listed on the market. So there are continuous obligations that also are obligations of especially disclosure. So for example, if you are a public company, from that time on, usually you have a website. On the website, you publish, for example, the call of a meeting of shareholders, the call of a meeting of directors. Everyone can see the agenda of that meeting. Everyone can vote on specific items. So in reality, I mean, things are no more private, but they are public. You go, of course, as a company, as an issuer, you might even catch the first headlines of a newspaper, but at the same time, this pleasure of being famous, for example, is counterbalanced on the fact that you must disclose information. Balance sheets also are published, and are you can access those balance sheets are public. In addition to this, the balance sheet, if you are a public company, must be certified by accountants, specific accountancy firms like PricewaterhouseCoopers, Deloitte, KPMG. Those the big three, essentially, they are called, and those usually they are the accountants of very big corporations that are listed on the market, and it is a legal, mandatory, compulsory requirement in many jurisdictions that if you are on the market, you must appoint for a period of at least 3 years one specific accountant in order to certify every financial year your balance sheet. Then at the end of the period of 3-5 years, you can renew the same accountant, or you can change, maybe from PricewaterhouseCoopers, then after 5 years you can appoint KPMG. So this is how even those companies, they work. Essentially, these accountants, they have clients because the clients, they must have an accountant of that level to certify the balance sheet. So it's not something that is discretionary. They must have it. So those are the obligations that are called continuous obligations of the secondary market. So the market where you trade your shares. And of course, shares, just to say, if you go eToro, for example, it is an app, and you can, as a retail investor, you can invest in shares. So in reality, you can, through a stockbroker, buy shares, and you can play the role of the bull of the market. So in reality, eToro, for this reason, because you buy shares today, maybe at $10 per share, and you hope that the value is going to rise, and then you sell those shares. Once you sell, you make a profit. So this is the bull phenomenon that is different from the bear, the bull and the bears of the market. So the bears of the market are those that they bet against the value of a company. They say that that company has a problem, and the value of the shares today, usually they say it is overvalued. So they predict that between now and 2 months, the value of the shares are going to collapse. And so those are the bear of the markets. And for example, Jacob Little, for example, was the first bear of Wall Street. This is something that, I mean, I started to know because I am in the process of finishing my next monograph, that is the Speculator of Financial Markets. And so essentially that is the financial history of the world, where I show this new beginning of speculation between bull and bears, and how speculation mattered from ancient Rome until modern days, and SPACs and artificial intelligence, sustainable finance, crypto finance, and so on. So in reality, that is a book that is even informative for many people that they work even in other sectors, that can be sociology or can be also people of the street. Essentially, everyone can read it because it's written in an accessible language that is not very academic, but is more like a sort of romance. And that is where essentially you understand that there are 2 opposite forces, the bull and the bears in the market, each one to perform a different activity, essentially. And each one is important within financial markets. So if now this is clear, the last step before closing essentially is to introduce you to the idea of the special purpose acquisition company. It's a new idea because actually it's new for many, because it started to become popular since the beginning, I mean, of 2020. But then still 20, 30 years ago already in the US, we already had special purpose acquisition companies. So in the US, I mean, it's a phenomenon that is not so new. But of course, the majority of the world and people in the world probably they started to know more about special purpose acquisition companies since the fact that in 2020, they raised proceeds for over 80 billion. So this trend continued in 2021 with over 100 billion. So this kind of increase of special purpose acquisition companies offerings was so relevant that many people in the world they started to look at the phenomenon. So today, for example, we have new regulatory frameworks that are designed for special purpose acquisition companies, and we can find this in Spain, in the UK, probably in Europe. The UK is the only country that, although today, of course, is not a member state of the European Union anymore, but still the UK is close, of course, to Europe. So geographically is a European country. As the European country is the only European country that as a specific and harmonized framework for special purpose acquisition companies. Then we have Italy with some rules, Amsterdam, and all the world. So essentially Singapore had the new SPAC reform, Hong Kong, new SPAC reform, Korea also, Malaysia updated the guidelines. Its own guidelines in Malaysia were updated in relation to special purpose acquisition companies. Then we have rules in Canada. We have rules, of course, in the US, that is the main country where essentially here also you can see the importance of securities regulation, of American securities regulation, because then all these other countries, they are all copying and paste more or less what the US did. So securities regulation are essentially US-centered. And this is especially true also in SPACs. So there are many countries in the world that they started to adopt, even Indonesia is thinking to adopt those new rules. And South American countries also are thinking still about this. Are thinking because actually regulation in SPACs is not compulsory. I mean, in the sense that you don't have to have a specific legal framework for SPACs, because at the end of the day, the special purpose acquisition company, that is this red box here in the slide, it is a company that is listed on the market. How you can get listed? Through an initial public offering. So if you don't design as a jurisdiction specific rules for SPACs, still the normal traditional rules of every country still applies to you. So the rules of prospectus, the rules of offer documents, the rules of one specific market segment where you want to list will still apply to you as a SPAC. So you don't need always a specific framework. Of course, if you have a specific framework, sometimes it's better because you can give a possibility to investors to get listed easily on your jurisdiction, or can be also be a sort of marketing, motive, like that you want to sponsor your country by showing that you are SPAC friendly, for example. So this is something that really has a political connotation. For example, the UK wanted to adopt a SPAC framework mainly because there was a frenzy in the US between 2020, as I said, and 2023. And so to try to steal some investors, to lure the attention of some public investors in the US to move in the UK, they started to have a specific framework on SPACs. This framework, in any case, was not very competitive, how it was designed, because it created also some kind of obstacles. And so for this reason, at the end of the day, was not the best regulation possible, and still, in fact, did not attract the attention of many SPAC promoters. So still, we don't see a huge attention in the UK to this process, to this phenomenon. Although, of course, the person that was promoting the possibility to have a SPAC framework in the UK was the current Prime Minister, Sunak. So he was Vice Chancellor by the time of the SPAC reform, and then he became Prime Minister. But generally, he is a little bit business oriented. So he knows that essentially the UK did wrong this SPAC reform, did wrong a little bit things on dual class shares. So this kind of financial innovations, they will probably be retouched essentially in the future to make the UK even more competitive. Coming to this slide so that I can explain to you in a more precise way what is a SPAC. The SPAC is the red box. And what the SPAC wants to do is very simple. The SPAC, that is the red box, wants to buy the yellow box, that is the target company. The target company today is a private company. As a private company, would like to become public. So rather than going to the traditional IPO route that we commented until now, so you should know very well now what is a traditional IPO, the target company would like to be acquired by the SPAC in order to become public. So the SPAC, that is the red box, is already public. So today the SPAC is set up and today the SPAC is listed on the market. So for example, I don't know, it's going to issue shares on the New York Stock Exchange or NASDAQ for 400 million, for example, dollars. What is going to happen with that 400 millions? That 400 millions will be reserved to buy a target company. This target company usually can be an high growth company. So for example, we said the example of Facebook. Facebook was already a good company, big company, so could afford to go through a traditional IPO. If you think about other fintech companies, sometimes we said you are a startup, you have very good ideas, but you don't have enough capital. So alone, you cannot tap public markets. But because public markets can be good for all the motives that we said at the start of the lecture, probably you need a way to bypass the rules, or better, rather than bypass, really to have an alternative way to get listed. And this alternative is the special purpose acquisition company. So the company that is the SPAC is already listed on the market and has a lot of cash. With this cash, essentially, the target company can be the target of the SPAC and so can be bought, or sometimes it's the target company that is going to reverse merge with the SPAC. But whatever is the M&A transaction or the transaction process that is involved, at the end of the day, we do have, as you can see in this line tomorrow, the green box. So the merged entity is listed. So it means that the target company, that is the yellow box, at the end of the day, tomorrow, is going to become a green entity that is listed on the market. If you are listed on the market, you have been successful. So in reality, I mean, you could finally tap public markets, although alone probably you could not. Now, in this process, of course, this is very simple process and it works very well, but is also a process that might have some shortcomings. What are the possible shortcomings in your view in this kind of idea?
I guess, you know that I'm quite a critique of the SPACs movement.
Yeah.
But let's say that, for instance, in Colombia, I had the chance to talk with a person in charge of promoting new ideas in the stock exchange.
Mm-hmm.
And new markets, and he said that the most concerning thing about the SPACs is maybe the lack of transparency on how profit is being distributed along all the intermediaries, all those who participate in the process. And in the particular case of Colombia, the lack of sponsors. I mean, if you are in the UK or in the US market or in different European countries, that might not be an issue. But in the context of Colombia, it is. Actually, it is the first reason when you present the idea of SPACs to the market to decide that even though the IPO is more is costly, it takes time, it has a heavy regulatory burden, and they rather, those who can, of course, rather go through the IPO process rather than using SPACs. As you see, I don't remember, I am trying to remember the name of the Colombian company that went to the US market to do a SPAC, but I can't remember somehow. But the reason is that we are not that keen to move into financial innovation. Maybe because there's a lack of knowledge of how it actually works, how it would be successful to start a process of a SPAC. So I guess that's something very related to the culture of each market and how they're keen to take risk or not. But if you go to the Brazilian market or even in Mexico, of course the story is completely different. Also because they have they are great. They have more investors with higher profile of risk, I guess, than the ones that I participated currently in Colombia.
Yes, exactly. This can be, for example, in Colombia, I think, I don't remember when was this thing that we did, maybe a conference some time ago. And then I was presenting some SPAC examples in Colombia. So for example, there were SPACs, not SPACs, but there were target companies that then they were acquired by US SPACs, American SPACs. And so at the end of this process, a Colombian company could be listed on the New York Stock Exchange. So for example, if there is, because essentially in developing countries, financial markets in all those developing countries, those financial venues are not very liquid. So what is really working is the private sector, and there might be many opportunities. So if you are a private company in the private sector, you are in the fintech area, for example, in Brazil, difference where on fintech, they were also especially the target of US SPACs. So for developing countries can be very alluring the idea then to be a company listed on one of the best or most famous exchanges in the world, that is the New York Stock Exchange. The reality, the SPAC is a competitive process that also has a problem, first of all, from a political perspective. The fact that because the US markets are very prestigious, then if we raise a lot of money in the US and we have the ability to buy out many companies around the world, this can create some concern from a political point of view, because in reality, for example, even in Italy, Xenia Group, that is in fashion, now is listed through a SPAC in the on the New York Stock Exchange. UK Arrival, UK Kazoo, there are two companies quite big that now are listed on the New York Stock Exchange. So in reality, New York Stock Exchange did shop around during these months, and I think will continue to do. And so this is something that one shortcoming in SPACs is that, I mean, sometimes this kind of aggressive type of acquisitions can cause a problem from other countries, because the domestic companies that maybe sometimes are even famous, they might become Americans. So this is something that is a first thing that sometimes can also induce countries to think about some mechanism of defense. One point for sure that is true is that in SPACs, there might be incentives that are not aligned together. So for example, the SPAC, as we said, it is sponsored by a sponsor of the SPAC that usually are businessmen, or sometimes might be even companies, it depends. This is not very important, but what is important is that the company or the sponsor, they really know what they do. So they are very famous in the sector that they want to target. If the SPAC wants to buy something in the shipping industry, you must have experience in the shipping industry as the manager of the SPAC. Now, because you have this experience and because you put in place your knowledge in order to identify the right target, you would like to have a compensation for this. This compensation as a target or as a promoter of the SPAC is called the promoter. So you will receive founder shares that are discounted rather than be paid $10 per share. That is the classic amount that every public shareholder of the SPAC is going to pay if they want to become SPAC shareholders. You as a sponsor, you will pay $0.01, for example, 1 cent of a dollar. So in reality, you pay nothing. Usually you pay $25,000 to have the equivalent of 25% of the share capital of the green box. So the green box is a company that has a market capitalization of millions, and you have the 25% as a sponsor only with $25,000. So in reality, this is something that has created concern, especially in the US, because the US is very aggressive in these ideas. While in Europe, for example, this didn't happen. It's something that, I mean, is more US focused, this kind of approach, because also it's a capitalist country. So in reality, if I am the one that has the capital, if I am the one that has the idea to sponsor the SPAC, I have the idea to have a right target, for example, I should be compensated. And this type of compensation sometimes is exaggerated. So what they did to mitigate this problem, actually, is that in this moment, there are many sponsors, they are creative. So they say, rather than taking 25%, I will take at the start 10%. And then if I create value also for SPAC shareholders, I will increase this kind of compensation up to an amount of 20%, but only if the value of the shares that are traded on the market is more than $10 per share. If becomes less, in proportion, I need to reduce also my kind of compensation as a sponsor. So this, for example, is a good way to align the interest of sponsor to the public investors. So it's something that can create an incentive to work together. So it all depends, but generally, let's say the SPAC is a new product. So this is the main point. It is not something old or something established. It's something new. It is something that might be even more established in the US because then, because there were all these problematics and so conflict of interest of the sponsor, if the SPAC is going to buy, maybe the target company is a friend of the sponsor. So this is a clear conflict of interest where the sponsor is helping a friend rather than creating value for the SPAC shareholders. So because of all these problems, the Security and Exchange Commission proposed new rules. So a real SPAC reform in the US that has been proposed since March 2022. Now, I mean, we are in the summer 2023, is more than 1 year. It's more than 1 year, we don't have clarity if this reform will pass. But if this reform will pass by the end, for example, of this year, or maybe the start of 2024, you need to remember always that will be the biggest, for example, reform in securities regulation since 100 years, because the Securities Act is 1933, and now we are in 2023, so it's already 100 years. Never in 100 years something has been touched on the Securities Act or the Securities Exchange Act 1934. But now this reform on SPACs in the US propose different reforms and different makeups on those big securities acts. So if those acts will be touched, of course, this will give a way to be legitimate, even more legitimate in the US. So SPACs, actually with that reform, one point of the reform was to actually make the SPAC more similar to a traditional IPO. So in reality, if this kind of reform is approved, might even be possible that in the future sometimes is even 20 years from now, for example, but maybe the traditional IPO will start to be always less common, and the SPAC will start to be always more popular and more used and more standardized. So in reality, even investors, even businessmen, they will start to understand always more SPACs, be less afraid, and they will start to, in reality, I mean, settle an idea that started in a way that was always, for example, if we think also the South Sea Company in 1720 in Britain, for example, in the UK, that caused, for example, a sort of bubble, the South Sea bubble. That is interesting, but then without that speculation, without that bubble, the British government could not, for example, restructure its own debt. So the restructuring of debt was deriving from a bubble. So this is something that I will say also in this speculator of financial markets, that sometimes we have negative phenomenon in the market, like crisis and bubbles, credit bubbles. But then at the end of the process, we always find out that there is a new financial innovation. We always find out that in reality, the progress of society in our cultures has always been a process that has taken time, and always a process that in reality, I mean, is not done in one day. So it's something that takes time for sure. So this is how the SPAC might play a role in the future. And this is always for you to remember. The main question why we needed the financial regulation is that we don't know this question. We need financial regulation, or we need self-regulation in terms of SPACs. This is something that is an open question. If you want to know more in general about SPACs and all these rules that I listed for you between Europe, the US, you can also have a look to this Mergers, Acquisition and International Financial Regulation. That is a book that I wrote on SPACs in 2021 that also Catherine was mentioning at the start of the presentation. This book now, there is a new version, like I think it's this month that they issued the new version that is paper version. So in reality, there is not the hard copy that usually is very expensive, but there is a very cheap version, for example, of the same, that is a paperback copy. And it is available from this month, for example, by Routledge on the website of Routledge. In Amazon, I think I still see the hard copy. But if you want even to know more things apart this book, you can always download for free in Cambridge University. There is my last paper on SPACs, that is From Darkness to Light. So in reality, that is the title of the paper, and is in free access. So in reality, you can download the paper on Cambridge Yearbook of European Legal Studies. So this is always something that if you're interested, you can already have a look, especially in that paper, about the new reform in the US, the reforms that took place in Europe, and also in the UK. So in reality, that paper is quite the last idea on SPACs that you can find in academia, and also from a professional perspective, because I know that some of you are professionals of financial markets, so probably that paper, also the book, but that paper, I mean, you can read already from today if you download it for free on Cambridge. That already gives you an idea about SPACs and the current state of the art of SPACs in Europe and UK and the US. So with this, I mean, I think I conclude my speech lecture of today, but I open the floor possibly, I mean, if there are questions, if you wanted some clarification. Thank you very much.
So I just share on the in the chat the link to your book.
Yeah.
And
Yes.
for those of you that might be interested in having a look on this, remember that we will have the recording available for those who are part of this course. Thank you, Daniel, for being us today.
Thank you very much.
I think it was very, very clear presentation from the very basic concepts of capital markets and so on. And we look forward for the next opportunity to have
Absolutely.
you, hopefully here in Colombia, visiting us.
Yes, would be very nice.
Thank you,
Absolutely.
Daniel.
Thank you very much. Thanks to you.
Nice afternoon. Bye-bye.
Bye-bye. Bye-bye.